watching Stock Watch with me, Zinati Guma. Joining me to unpack your stock-related questions tonight are Roy Mutooni from Sanlam Investments and Shane Watkins from All Weather Capital. Please be sure to send those questions via SMS to 41392, email at stockwatch@bdtv.co.za or tweet us at BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. As I was reading that intro, I felt a sneeze coming on, and I feel like that's actually been what markets have been doing. There's something that they're holding. They're not sneezing to take them on either direction. It's pretty mixed and undecided at this point. Shane, I want to start off with you. What are you making of the markets trading, I guess, in the past 2 days after we've had such a good month?
So, Zanati, unfortunately, there's an expression that South Africa goes to all of the funerals and none of the weddings. And if you take the US market and the NASDAQ in particular, they're up nearly 50% for the year. So for investors in the United States, it's been an extraordinarily good year, but the JSE, except for the bounce in the last month, at some point it was actually down for the year.
Yeah.
So now maybe the market's up 5%, but it's been a pedestrian year for SA equity investors. And I guess that is driven by two things. I think, firstly, very poor economic fundamentals in South Africa. I mean, the economy is growing less than 1%. And the other factor is, at the beginning of this year, we had a change to Regulation 28, which is the regulation governing pension funds. And that essentially allowed South African pension funds to take their offshore loans from 30% up to 45%. But in order to take that money offshore, they had to sell South African equities. So there's been meaningful selling by large SA pension funds of South African equities, which has put pressure on prices. So, in short, our market has had a very tough year, driven partly by poor economics and partly by technical selling for Reg 28 reasons.
Yeah. And I mean, just actually, as we're talking about all the challenges in the country that are, impacting these companies, it was quite interesting to see that 4-month voluntary update from Bidvest. And I mean, this is considered a very, very defensive stock, and as much as on some level it's considered the bellwether for the South African economy, it's managed to outperform the actual economy. But now saying that the first 4 months of the FY24 year has been muted, and of course we saw something that we are not used to seeing on that front, with the share price plummeting by, was it about 10% at the end of the day, if I'm not mistaken. Roy, what are you making of this company, this huge outperformer, and then all of a sudden just coming down like this? Is it just a thing of, no one is immune to this kind of environment, but even then, maybe it's not something to fret about too much?
So yes, it was quite an interesting update considering all this. I mean, in the previous period, they grew by, was it like 20%? So they did incredibly well. And when you looked across the whole business, everything was firing. But you had an inkling at the very beginning when they announced their results, which was basically that gross margins were under pressure, but they've done very well from an expense perspective to manage their earnings and to manage their businesses. But what was interesting was the businesses that did well, which is basically freight and services, those are the ones that they're defensive. They're not exactly SA Inc. They've got annuity revenue and they're related to commodity exports and food exports and imports. So those were solid ones. Just remember, there's a huge component of this business that is actually consumer oriented, that is a trading business. And that's what we saw in this trading update. So effectively what they're saying is volumes are not growing, there's pricing pressure and there's cost pressures. So up until now, they've done very well, but no one can escape the environment that they're in. And that's probably what that update was. Whether we're talking about motor, whether we're talking about the other trading businesses like commercial and paper and everything. But masked within all that was a very strong performance by the international business and sustained acquisitive activity internationally. So that adds up really nicely. So yes, quite a difficult trading update, not entirely unexpected because of the big base, but I think there's also some good stuff there. I don't think this is time to throw this one into the garbage can. I think investing is a long-term game and not everyone can grow all the time.
Yeah. Shane, on this front, I mean, do you think that obviously they pointed out these pressure points, but overall the business still looks good? Do you think that this is maybe an overreaction on the market, or maybe mixed with investors taking profits after such a great period for Bidvest?
So Zanati, I guess the thing for Bidvest was the share was quite expensive relative to our market overall. Like, let's say it was trading on, maybe a 13 or 14 PE, and there are plenty of pretty good South African shares trading on sub 10. So a company that is relatively expensive cannot afford to disappoint. You need to earn your premium. And I think in this instance, Bidvest can't trade at such a significant premium if they're going to deliver the same pedestrian results that everyone else is. I don't think I think it is a good company. I agree with Roy. I just think it's too expensive given the outcomes it's now delivering.
All right. I hear you on that. You need to earn your premium. There's a very interesting question here. Best high ROE JSE shares to hold for long-term compounding. Roy?
There's a whole bunch of those, particularly considering where share prices have gone. And I'll start with actually the one that was formerly in Bidvest, which is Bidcorp.
Yeah.
Quite high return on equity, quite low cost of capital. And more interesting is that they don't pay out a lot of their earnings. They compound them. So the ROIC grows, generates returns, and those returns are reinvested in the business at relatively high rates. So that to me is the simplest one, and it's not particularly expensive. Richmond is another example. I think you've seen where the banks are going right now, the big diversified banks, exactly the same thing. ROE may not be too high, but it's at a good premium to the WACC, because that's what you want. You want a premium to the WACC and the ability to reinvest into the business at that marginal ROE or ROIC. So I think those would be where I am. Bidcorp is the one that particularly impresses me because it's a global business. It's not an SA Inc. business, and they've been able to do this for a long, long time.
Yeah. Shane, just as you were talking about Bidvest maybe being too expensive for what they're producing, when you're looking at high return on equity stocks, how important is it also to look at the entry point?
So Zanati, I think that's a good question. So is it a high return on equity for the company, or is it a high return for the investor? And sometimes you can get companies that have a very high return on equity, but the share price is already reflecting expectations of that high return on equity. And in that instance, the outcome for the investor may be a low return. So, in general, Roy is absolutely right. Return on equity is probably the single most important determinant or measure of how good a company is. But if you're looking for what returns can investors generate, then sometimes you have to buy companies that are kind of beaten up and have a low return on equity, and that will result in a high return outcome for the investor, which is maybe where this question was coming from. And in that regard, I guess there are two companies that I want to recommend, or I want to discuss, rather, should I say, and that is MultiChoice and Pick n Pay. Now, both of these share prices are down over 50% for the year. Both companies have delivered quite poor results, in fact, very poor, but from here, you may find for investors they could be very high return opportunities. The MultiChoice share price was 150 Rand a year ago. It's now trading at 68. And MultiChoice essentially consists of a couple of different businesses, but in our opinion, you're only paying for the SA Pay TV business. You're getting the rest of Africa, which they were offered R1 billion for a couple of years ago, for free. You're getting Kingmakers, a betting business, which is a sports betting business, Pan-African sports betting business. You're getting that for free. You're getting Irdito, which is a security business in Europe, for free. So you're getting Showmax, which is a business that they've done with Comcast. You're getting that for free. So, sometimes, despite delivering a poor outcome, people focus, I think, excessively on the recent past, which has been bad, and they ignore what could happen in the future. And I think MultiChoice could be a good opportunity. And then the second idea that I have is maybe Pick n Pay. Now, I mean, it's incredible to think that 25 years ago, Pick n Pay was 50% bigger than ShopRite, okay? Now, Shoprite is 12 times the size of Pick n Pay. It has been the most extraordinary underperformance of a well-known, well-loved brand.
Yeah.
And they've recently brought in Sean Summers, who was previously the CEO, to fix the business. And I think he's going to have some hard yards in front of him, but there could be a good opportunity to fix Pick n Pay. And from here, you're almost paying option money. Pick n Pay is actually a small company, and if Sean can work even some mild sort of sensible interventions, we think that there's a good outcome there ahead for Pick n Pay.
All right. Well, quite an interesting question. Of course, we also saw today in some of the big winners, the gold counters today. Gold has outperformed most of the market over the last 10 years. What is your panel's view? I'm not sure if this is if it's actual gold or the gold miners, Roy, because gold would seem to be kind of at a standstill. So what do you make of gold, and I guess particularly the gold miners?
So gold is a very simple thesis in the sense that it's a store value. And the fact that it doesn't generate income means that its performance is supposed to be inversely related to where interest rates are, theoretically. Now, it's underperformed that. At this time, when interest rates were negative and zero, gold should have done really well, but it hasn't. And even more recently, it hasn't reacted to the geopolitical issues. But in the last couple of weeks, you've seen gold shares moving and the gold price going above 2,000. So without a doubt, it started performing. The thing about it is it's supposed to be highly uncorrelated. So if you add gold to a portfolio of equities or fixed income or throw them all together, your actual correlation is low, which means your portfolio volatility declines. So it has a place in the portfolio of most investors. Not necessarily a big place, but it does have a place. Now, gold equities, particularly when you talk about South African gold equities, the whole point there is leverage. So they spend in rands and sell in dollars. And you want, when the rand is weakening, they mine a whole lot more and then they're able to sell well. That's why people buy these stocks, for the leverage and the gold price. You're happy with gold, you get a bit of leverage and you go in. But that hasn't also worked simply because costs have risen very aggressively. We are producing far less gold than we did previously. So it's become very much a mug's game. I mean, they've really struggled operationally and they haven't got the leverage that people look for. That I think is the broad thesis on it. Right now, when you have US rates coming down, gold suddenly gets a little bit of a bid, and that's what we're seeing right now. Weaker dollar, you should see gold moving. Let's see if the paradigm holds this time. It hadn't held before.
Shane, does gold or gold miners have any place in your portfolio?
So, Nati, absolutely. Any share that goes up has a place in our portfolio. The problem with gold is that it's very difficult to predict. I think, for the metal price itself, there's been a geopolitical event that has overshadowed a little bit economic events, and that's been the war in the Ukraine. And what happened to Russia when they invaded the Ukraine? Russia had like $500 billion offshore in US bank accounts and in US treasuries. Essentially, the United States confiscated that from Russia. So their foreign reserves were taken away from them. And what this has done is it's made countries that feel that they may at some point get into an antagonistic relationship with the United States decide rather to invest in gold rather than US treasuries. So in some sense, it's changed the demand for gold. Now, the thing about gold is 98% of the gold is above ground and mined. A small amount is added by miners every year. So in a sense, the supply of gold is fixed.
Yeah.
So the moment you have a little bit of extra demand, you have an enormous price impact. And we know for a fact that the Russians have been buying gold, the Chinese have been buying gold, the Indians have been buying gold, Brazil has been buying gold. So a lot of countries have been adding to their gold reserves. And we now see gold trading pretty close to its all-time high. I mean, I think it's trading at 2,047 right now, dollars. It's closing in on 40,000 Rand an ounce. That's close to the all-time high ever, and that obviously is putting a fire under gold shares. So, I think our view would be, to the extent that it's possible to predict gold and gold shares, it's certainly, not that easy. We think certainly this isn't a good time to be underweight gold.
Okay.
We think that there's a secular trend where demand is increasing.
All right. Well, let's go into Zeda. Zeda came out with their FY23 results yesterday. The numbers are looking good and the stock is pretty cheap. Would any of the panelists consider buying and holding on to the stock for the next 3 years? Of course, we have actually seen quite a turnaround in investor sentiment on that stock, because it wasn't really something that investors were flocking to when it first listed. But now there seems to be have made a turning point. Roy, what do you make of Zeda? Would you be buying and holding for the next 3 years?
So just remember, one of the reasons that I think people were didn't take a shine to it was when they were unbundled from Barloworld. There's lots of people who got the shares who didn't want them in the first place, because it's a small cap stock without, and it's a different profile from what you get in Barloworld, which is capital equipment and the like. This one is car rental and consumer. So a lot of those people dumped their stock. Management team was new and unfamiliar to the market. So I think people have had a wait and see approach. The result yesterday was actually quite good. From an operating perspective, you can see the inbound tourism is working for them. Fleet leasing is working for them. They're benefiting from this move towards the roads, so they're able to rent cars on long-term leases, not cars, trucks, on long-term leases as well, because of all that's happening about the rail. So the business model is actually quite a sound one. The thing about this is it's going to always be a capital-intensive business, because they require gearing to generate returns and to buy these vehicles. But I think they've had a good start. I think the consumer side may struggle over time, which is the used car side and maybe the car rental. But then the fleet side, which I think is what they consider their jewel, that's got lots of potential. That's got lots of potential. And exactly like Shane said, the thing is you're getting in at your disappointment risk is low, because it's very cheap right now and there's nothing fundamentally wrong with it. So long as you have upside in earnings and you've got a very low valuation entry point, you have hope. The problem is when you buy an expensive share and the earnings turn.
I mean, talking about capital intensivity, because also that leads to debt, and debt has actually been one of the concerns that investors have had, but that seems to also have disappeared. I think also yesterday they mentioned that they made a settlement that it was 2 months before they were actually supposed to pay it. So it seems that they're making some inroads there. Shane, Zeda at this point, buy and hold or not?
Zanati, in order to be a successful equity investor, you haven't got to identify good companies necessarily. You've got to identify companies that other people think are good companies and buy them. And so, the question is, who is the universe of people that will buy Zeda? And, if I go back to what I said about the change to Reg 28 and, hundreds of billion of selling of the JSE and that money going offshore, what has tended to happen is SA equity investors have tended to hang on to the very, very good large cap, high quality investments like, say, Bidcorp, which Roy mentioned earlier, and I would agree with him what he said on Bidcorp. And they've tended to sell all the kind of, let me say, the rats and mice in their portfolio. So I can think of 10, 20, 30 very good quality small and mid caps that are trading on PEs under 10. And so, despite Zeda doing well, I'm not sure that it sufficiently differentiates itself among a universe of a number of unloved South African small and mid caps.
All right, I hear your point on that front. But there's a question here on Prosus. What does the panel think of Prosus? And I feel like I'm missing some sense on this company. Can anybody fill me in on what is coming up? Yeah, of course, there are lots of stuff that are always coming out, including the share repurchase program. I think the last thing that came out was the trading update, if I'm not mistaken. But also, yeah, this is a company that I'm also just like, you need to sift through a lot of things. Roy, is there anything important that you need to fill us in on this company?
Yes, there's results in the next couple of days, if I'm not mistaken.
Yeah.
That's for sure. But just remember, those are of no consequence. What's really important here is what you think about Tencent.
Yeah, okay.
And if you think Tencent is cheap and has upside, and you're a South African investor, you can't invest directly in Tencent, it's Naspers or Prosus. That's the thing. So the thing about it as well, just the narrative around it is new management. They've promised they're going to take the rest of the portfolio into profitability, and people want to see steps along that way, that the rest of the portfolio becomes more profitable and this buyback continues. So I think those are the key touch points. But one thing that's very clear is if the market soars on Tencent, there's very little you can do with either Naspers or with Prosus.
Yeah. Shane, coming to you, there's a question for you here. Which company do you think Sun International is trying to acquire? I mean, they took out that SENS yesterday and there were no details at all. Do you have any idea? and it's specifically for you.
We don't. What I will say is that I think Sun International have done a pretty good job post-COVID. I mean, remember, the entertainment stocks, and in particular the casino stocks, were very hard hit in the COVID era. And Sun International came through that. And, I think their hospitality business, Sun City, is doing extremely well now, and the gaming businesses are doing extremely well. And these casinos are very high ROE businesses. So, I think Sun International is a good story. What I would question is whether they should be buying back their own shares or they should be doing acquisition, because I think both Toga Sun and Sun International both look cheap. And in my opinion, the best thing they could do is buy back their own shares.
Yeah. All right. Yeah, actually, that's quite an interesting one, if they should be doing an acquisition or buying back their own shares. Just a quick one before we get to your stock picks. Of course, there's a viewer asking what happened to the Impala price today, dropped 8%. Of course, that was after the announcement of the tragedy that happened at Impala Rustenburg. And I'm actually just wondering, Roy, what are the consequences for Impala at this point?
Just remember what happens when you have a tragedy such as this, and that's exactly what it is. I think 11 lives were lost. There's probably 40 people in hospital. When something like this happens, production stops immediately. A safety inspector must come, and a full review of safety must be done across the board. Management has to go out and speak to the families and everything. So you'll have a production stoppage for a period of time. So that's that. But I think not just for Impala, but across the board, the mining sector in SA, they've done incredibly well. If you look at the chart from 94 on until now, fatalities and all of that have reduced in almost a straight line. And so they've done a whole lot of good there. But this, I haven't heard something as tragic as this in a long time. It's going to shine a light on the costs associated with safety and the protocols around safety, and that's going to refocus the industry back there, especially now where with low commodity prices and low demand for commodities, especially PGMs, companies might be persuaded to either cut costs or go down a less expensive route, save money in some way. So a much bigger renewed focus on health and safety is definitely what's going to come out of this. That's the one thing that's for sure.
All right, gents, we have run out of time. 10 seconds for your stock picks. I know that's not a lot of time. Shane, what will your stock pick be for today?
So Zanati, I would go with Pick and Pay. As I've said, the business trades at a fraction of the valuation of ShopRite, and my belief is that Sean Summers, who ran the business very successfully 20 years ago, will ultimately turn this business around into a smaller but more profitable business.
All right. On your side, Roy, your stock pick?
Bidcorp. I think global growth is slowing, but in reality, in the economies in which they operate, eating out is a norm, and there's been a big trend away from buying to cook and eating out. Those economies are generally high GDP per capita economies, so even when things are struggling, people tend not to revert towards the retail. It's cheap, highly cash generative, and well diversified across major developed economies.
All right. Well, it does help that we also spoke about these stocks earlier on as well. Thank you very much for helping me out with that, gents. I really appreciate your analysis today. That is all for Stock Watch this evening. Thanks to our guest Roy Mutooni from Sanlam Investments and Shane Watkins from All Weather Capital. Coming up next, The Close. Stay with us.